There's a moment in every financial cycle when the people in charge stop driving the car and start praying the brakes still work. We are in that moment right now. The Federal Reserve, the most powerful central bank on the planet, the institution that prints the world's reserve currency, the group of economists who are supposed to steer the largest economy in history, has quietly run out of clean choices. Every door in front of them leads to pain. Every lever they pull breaks something else. And the worst part? They know it. You can hear it in the way they speak now. The confidence is gone. The certainty is gone. What's left is careful language, vague timelines, and a hope that the math somehow fixes itself before the public figures out what's really happening. But you're already figuring it out. That's why you clicked on this video. You feel it at the grocery store. You feel it when you open your credit card statement. You feel it when your paycheck hits the bank and disappears faster than it used to. You're not imagining it. You're not bad with money. The ground underneath the dollar is shifting, and the people who are supposed to keep it steady are improvising in real time. In the next few minutes, I'm going to walk you through exactly why the Fed is trapped. What the 3 possible paths forward actually look like for a regular person. What to watch for in the coming months. And most importantly, how to build a system so that whatever happens next doesn't happen to you. It happens around you, while you stay calm, prepared, and in control. Before we go any further, if this kind of plain English breakdown is useful to you, take 1 second and hit that subscribe button. It's free, it costs you nothing, and it's how this channel keeps reaching everyday people who are tired of being talked down to by Wall Street. Subscribe and let's keep going, okay? Let's talk about the trap. The Federal Reserve has essentially 3 options on the table right now, and I want you to understand each one not as an economist would explain it, but as a person who actually has to live with the consequences. Option 1. Cut interest rates. On the surface, this sounds great. Lower rates mean cheaper mortgages, cheaper car loans, cheaper business borrowing. The stock market loves it. Headlines turn green. Politicians smile. But here's what they don't tell you on the evening news. When you cut rates while inflation is still alive underneath the surface, you're pouring gasoline on embers. Prices that were finally starting to cool off begin creeping back up. So the dollar weakens against other currencies, which means the imported goods you buy, electronics, clothing, fuel components, even some food, quietly get more expensive. Your paycheck stays the same, but it buys less. That's not a recession on paper. That's a recession in your kitchen. And once that cycle starts, it's incredibly hard to stop, because the moment people expect prices to keep rising, they start spending faster, demanding higher wages, and the whole thing feeds itself. Option 2. Keep rates high. This is the path of discipline, the path the Fed says it wants to walk. Hold the line, crush inflation, restore credibility, and in theory, that's the responsible move. But high rates for a long time are like a slow tightening of a belt around the entire economy. Small businesses that survived on cheap credit start to suffocate. Regional banks, which are sitting on portfolios of low-yield bonds they bought back when rates were near zero, watch the value of those holdings collapse. Commercial real estate, office buildings, shopping centers, starts to wobble because owners can't refinance at these levels. And consumers? Consumers get hit hardest of all. Credit card interest rates climb past 20, sometimes 30%. Auto loan defaults rise. Mortgages become unreachable for first-time buyers. The economy doesn't crash in a single dramatic day. It just slowly cracks, one foundation at a time, until something important breaks. Option 3. Stimulate again. This is the emergency button, the one they swore they'd never press again after 2020. Quantitative easing, balance sheet expansion, liquidity injections, whatever name they give it that week. This option buys time. It calms markets. It keeps the system standing. But every time they pull this lever, they pay for it with something more valuable than money. Pay for it with trust. Because the rest of the world is watching. Foreign central banks are watching. Big institutions are watching. And every time the United States solves a crisis by creating dollars out of thin air, more countries quietly start asking whether the dollar should really be the center of everything. That's not a conspiracy theory. That's a slow-moving shift you can see in the data, in trade agreements, in central bank gold purchases over the last few years. So those are the 3 doors. Cut and risk inflation. Hold and risk a break. stimulate, and risk the dollar's long-term standing. There is no fourth door labeled "everything goes back to normal." That door doesn't exist anymore. Quote, and the longer the Fed pretends it does, the more pressure builds on the people who can least afford it, which, statistically, is most of us. Now let's talk about what happens next actually looks like, not in a textbook, but on a Tuesday afternoon, in a regular American household. The first thing you notice is that the cost of living stops behaving like it used to. Inflation, the way most people feel it, isn't really about the official number on a government report. It's about the slow, frustrating realization that the same cart of groceries that used to cost $90 now costs $140. And nobody can tell you exactly when that happened. It's the gas pump. It's the electric bill. It's the insurance premium that quietly went up at renewal. It's the rent increase your landlord called just a small adjustment. None of these things crash the economy on their own. But together, they crush the household budget. And when the household budget breaks, everything downstream of it eventually breaks too. Retail spending, restaurants, travel, small businesses, local jobs. The second thing you'll notice is that the consumer, the engine of the entire American economy, starts running out of fuel. For the last couple of years, a lot of people kept spending by leaning on credit. Credit card balances in this country are at historic highs. Buy now, pay later services have quietly become a lifeline for groceries and gas, not just luxuries. Auto loan delinquencies are climbing, and savings rates, which spiked during the pandemic, have been drained back down to the bone. So when somebody on television tells you the consumer is strong, what they really mean is the consumer is still spending. Those are not the same thing. One is health. The other is momentum on borrowed time. The third thing you'll see is volatility. Real, sharp, exhausting volatility in the markets. Not because the fundamentals change overnight, but because every single Fed meeting, every jobs report, every inflation print becomes a coin flip that moves trillions of dollars. You'll see green days that feel like the bull market is back. You'll see red days that feel like the world is ending. And both will happen in the same week. This is what late cycle markets look like. They don't go quietly. They thrash. And underneath all of it, there is a quieter, more important shift happening. A shift in trust. Trust in the dollar. Trust in institutions. Trust in the idea that if you just work hard, save a little, and follow the rules, the system will reward you in the end. That trust is cracking, not shattering, not collapsing, but cracking. And once people start to feel that crack, they start making different decisions about where they keep their money, what they invest in, whether they buy a house, whether they trust a bank. Those decisions, multiplied across millions of households, are how economies actually change. Now I want to take a quick second here, because if any of this is landing for you, if it's making you think differently about your own situation, do me one small favor. Drop a comment below, even just one word, even just the city you're watching from, and hit the like button. It genuinely helps this video reach other people who need to hear it. And it tells me to keep making content like this, instead of the usual recycled noise. Comment, like, and let's keep moving. Now let's talk about something that gets thrown around constantly in finance circles. And I think it's one of the most misunderstood phrases of our time. Buy the dip. You've heard it. Every podcast, every influencer, every comment section. When the market drops, just buy the dip. When stocks crash, that's your opportunity. When real estate corrects, scoop it up. And technically, historically, that advice has worked beautifully for a very specific group of people. The people it works for are the people who already have cash sitting on the sidelines. People with stable income that doesn't depend on a volatile job. People without high-interest debt eating their paycheck alive. People who have a plan written down before the dip ever happens, so they're not making emotional decisions in the middle of a panic. For everyone else, buy the dip is a fantasy. Because in a real downturn, the dip doesn't show up alone. It shows up at the same time your hours get cut, at the same time your bonus gets canceled, at the same time your industry starts laying people off, at the same time your emergency fund is being drained on basic expenses. So when the so-called opportunity finally arrives, you don't have anything left to deploy. You're not buying the dip. You're surviving it. And that's the part nobody on financial television wants to admit out loud, that downturns transfer wealth. They transfer it from people who were unprepared to people who were prepared. Always have, always will. This is why the goal is never to predict the dip. The goal is to be the kind of person who is ready when it shows up, whether it shows up next month or in 3 years, and we'll get to exactly how to do that in a few minutes. But first, I have to address something that confuses almost everyone who is paying attention right now. Why does the stock market keep going up while regular people feel poorer? How can the headlines say markets reach new all-time highs while you personally feel like you're falling behind? It's not a glitch. It's not media manipulation. It's actually the result of how modern markets are structured, and once you see it, you can't unsee it. The stock market is not the economy. I'll say that again because it matters. The stock market is not the economy. The stock market is a weighted index of large corporations, dominated by a handful of mega-cap technology companies. When those few companies do well, because they're cutting costs, automating jobs, raising prices, or buying back their own stock, the index goes up. That doesn't mean the average worker is doing better. In many cases, it means the opposite. A company that lays off 10,000 people often sees its stock price rise the same day because Wall Street rewards efficiency, not employment. On top of that, when interest rates are unusual, when liquidity sloshes around, when investors don't know where else to put their money, capital flows into the biggest, safest-looking names. So you get this strange situation where 7 or 8 companies are pulling the entire index higher, while thousands of smaller businesses underneath the surface are struggling. The headline says market up. The reality says concentration up. Those are very different stories. And then there's the wealth effect, which works in only one direction for most people. When stocks rise, the people who own a lot of stocks get richer. That's roughly the top 10% of households, who own the vast majority of equities in this country. When stocks rise, your neighbor who has a paid-off house and a fat brokerage account feels wealthier and spends more. But if you don't own significant assets, that rising market doesn't lift you. It just raises the price of everything around you, homes, rents, even groceries, because wealthy spending fuels demand. So you end up in this painful position where the country looks rich on paper, and you feel poor in person. You're not crazy. You're not failing. You're just standing on a different side of the asset line than the headlines are written for. So if the Fed is trapped, if the consumer is stretched, if the market is concentrated, and if the dollar is under quiet pressure, what do you actually watch? What are the real signals, not the noise? Let me give you a simple watch list. 7 things. You don't need a Bloomberg terminal. You don't need to be a trader. You just need to know what to glance at every couple of weeks. The way you check the weather before a long drive. The first one is oil. Oil is the bloodstream of the global economy. When oil prices spike, almost everything else eventually follows. Shipping, food, plastics, manufacturing, airfare. Watch the trend, not the daily move. A slow, steady climb in oil over months is one of the clearest early warnings of returning inflation pressure. The second is the 10-year Treasury yield. This is the number that quietly sets the price of money for the entire country. Mortgages move with it. Corporate borrowing moves with it. Government interest payments move with it. When the 10-year yield rises sharply, it means the bond market is nervous. About inflation, about debt, about the future. When it falls sharply, it usually means investors are running for safety. Either extreme tells you something. The third is credit card delinquencies. This is the heartbeat of the American consumer. When delinquencies rise, it means households are running out of room. They're not just spending less, they're failing to pay what they already owe. That's the moment the so-called strong consumer narrative falls apart, and it usually shows up in the data months before the headlines catch on. The fourth is unemployment, but watch it carefully. Don't just look at the headline rate. Look at the trend in weekly jobless claims. Look at hiring freezes. Look at the average length of unemployment for people who lose their jobs. By the time the unemployment rate jumps in an obvious way, the cycle is already well underway. The early signals are subtler: fewer job postings, longer searches, shrinking hours. The fifth is the dollar's strength against other major currencies. A wildly strong dollar pressures emerging markets and global trade. A wildly weak dollar fuels imported inflation at home. Either extreme creates instability. Watch the direction, watch the speed, and watch how foreign central banks are responding. The sixth is the language the Fed itself uses. Forget the rate decision. The decision is almost always priced in before it happens. The real signal is the wording of the statement, the tone of the press conference, and how it shifts from one meeting to the next. When officials start using words like patient, data-dependent, uncertain, or evolving conditions, they're telling you they don't know what's next. That's important information. And the seventh is consumer spending, especially on the things that signal confidence: restaurants, travel, big-ticket items like furniture and appliances. When people pull back from those categories, it's not just a number on a chart. It's millions of households quietly deciding to brace for impact. You don't need to react to every wiggle in these indicators. You just need to watch the direction of the river. Because when several of them start moving the same way at the same time, that's the signal. That's when you know the conversation is changing. Now let's talk about you. Because everything I've said up to this point is just context. Context doesn't pay your bills. Context doesn't build your future. What matters is the system you put in place between now and whatever comes next. So here is a simple framework. Not advice, not a prediction. It's just a way of thinking that has helped a lot of regular people stay steady when everyone around them was panicking. First, protect your cash flow. Cash flow is the oxygen of your financial life. Before you think about investing, before you think about strategy, before you think about anything fancy, make sure the money coming in every month exceeds the money going out, and make sure the gap is wider than it was last year. That might mean cutting subscriptions you forgot you had. It might mean having an honest conversation with your partner about spending. It might mean picking up extra income on the side. Whatever it takes, widen the gap. Because in a tight economy, cash flow is the difference between options and panic. Second, attack high-interest debt. Credit card debt at 20-something% interest is not a financial inconvenience. It's a slow-motion emergency. Every month you carry it, you are working for the bank instead of yourself. Pay it down aggressively. Negotiate rates. Consolidate where it makes sense. Treat it like a fire on the roof of your house, because mathematically, that's what it is. Third, keep reserves. Cash reserves are unsexy. Nobody on the internet brags about their savings account. But cash is what gives you the power to say no. No to a bad job, no to a panicked sale, no to a desperate decision. Aim for enough to cover several months of essential expenses, not in crypto, not in stocks, not in anything that can drop 50% overnight. Boring, accessible, available cash. Fourth, do not panic sell. When markets fall, the worst decisions are made in the first 48 hours. People sell at the bottom, lock in losses, and then watch the recovery from the sidelines. If you have a long-term plan, the plan was built knowing that downturns happen. Trust the plan you made when you were calm, not the fear you feel when you're not. Fifth, invest in phases. Nobody, not me, not the Fed, not the smartest analyst on Wall Street, knows exactly when the bottom is in or when the top is in. So instead of trying to time it perfectly, build positions in phases. Spread your buying over weeks and months. Boring? Yes. Effective? Also yes. Sixth, avoid leverage. When everything looks calm, leverage feels like free money. When things turn, leverage is what wipes people out. Margin, risky options, borrowing to invest. These are the tools that turn ordinary downturns into personal catastrophes. Stay off them. And seventh, stay inside your circle of understanding. If you can't explain in plain language what you own and why you own it, you don't really own it, it owns you. Stick with assets you actually understand. The exotic stuff almost always punishes people who don't know what they're holding. Here's the truth I want to leave you with, and I want you to really sit with this one. Most people who get hurt in the next chapter of this economy are not going to get hurt because they failed to predict the crisis. Predictions are easy. Everyone has one. Half of them will be right by accident. People are going to get hurt because they had no system when the moment arrived. No emergency fund, no plan for their debt, no strategy for their investments, no clear sense of what they own or why. They're going to get hurt because they spent years reacting instead of preparing. And when the storm came, they had nothing built underneath them to stand on. You don't have to be one of those people. You're already ahead. Just by sitting through a 15-minute video about something most people would rather not think about. That instinct, the instinct to look honestly at what's coming and prepare for it, is rarer than you think. Protect it, use it, build on it, quietly, calmly, week by week, While everyone else is arguing on the internet about who's to blame, the Fed has lost control of the easy choices. They have not lost control of yours. If this video gave you even one idea you can actually use, do me a favor, drop a comment below telling me which part hit the hardest, and hit the like button before you go. It's a small thing, but it matters more than you know for getting this kind of content in front of the people who need it. And right now, on your screen, you'll see another video I put together that goes even deeper into how to protect your money in times like these. Click it, watch it next, and let's keep building. Take care of yourself, take care of your family, and I'll see you in the next one.